Today we are set to issue the monetary policy statement, and the Deputy Governor and his team are ready to execute that mandate. For introduction, the Deputy Governor is Mr. Michael Atingego, and he's accompanied by his team of 3 executive directors. Executive Director Research, Dr. Adam Mugume; Executive Director Supervision, Dr. Twinemans Tumubwaine; and Executive Director Operations, Dr. Charles Abuka. I am Dr. Natamba Bazinzi from Communications Department. So you are welcome. Deputy Governor, sir, it's your turn now to issue the statement.
Thank you very much, Director Communication. And a very good afternoon to all the viewers and the listeners. Welcome to the reading of the Monetary Policy Statement for the month of June 2023. At its meeting held on 13th of June 2023, the Monetary Policy Committee maintained the central bank rate at 10%. Uganda's economy has demonstrated notable strength and resilience amidst unpredictable global economic dynamics. Inflationary pressures are easing, and economic recovery is underway despite ongoing uncertainty and evolving risks in the global economy. The Uganda Bureau of Statistics data for October 2022 to May 2023 shows that inflation has declined on account of steadfast and prudent monetary and fiscal policies, stability in the exchange rate, and due to the falling food, energy, fuel, and utility prices. Annual headline and core inflation decreased to 6.2% and 5.6% in May 2023 from 8% and 6.8% in April 2023, respectively. Annual inflation for electricity, fuel, and utilities receded to 0.9% in May from 2.1% in April 2023. Similarly, food crop inflation eased to 15.7% in May 2023 from 25.3% over the same period. Inflation for goods, including imported items, declined to 7.4% in May from 8.8% in April 2023. Also, services inflation has remained low, averaging 4.2% since January 2023. The contractionary monetary policy stance pursued since June 2022 to date, coupled with the decreasing global inflation, is expected to reduce inflation further in the upcoming month. As a result, headline and core inflation are forecast to reach 5% in the third quarter of 2023 and remain stable around the target over the medium term, which is 2 to 3 years ahead. Despite the improvement in the near-term inflation outlook relative to the assessment at the MPC meeting of April 2023, the current inflation projections remain sensitive to elevated risks. The downside risks to the inflation outlook include potentially lower global costs and commodity price pressures, minimization of global supply constraints, favorable weather conditions, and sustained unused economic capacity. The upside risks to the inflation outlook include potentially higher demand pressures from a more substantial economic recovery, elevated import inflation, the tighter global financial conditions, which could weaken the shilling exchange rate, that in turn would exert pressure on consumer prices. Also, domestic food prices remain highly susceptible to the unpredictable weather patterns that would turn drier in the coming months. Currently, the MPC assesses that the near to medium term inflation outlook is trending downward, albeit subject to elevated uncertainty. Now, turning to economic recovery, the Uganda Bureau of Statistics estimates economic growth at 5.3% for the fiscal year 2020 stroke 2023, up from 4.6% in 2021 stroke 2022. The agricultural sector recovery, resilience of the services sector, and the considerable household consumption propped up economic activity, countering a less supportive external environment. Furthermore, high-frequency indicators signaled accelerated economic activity in the recent months. Also, consumer and business sentiments have exhibited positive momentum. The MPC projects economic growth in the range of 6 to 6.5% for the fiscal year 2023/2024. Economic growth is anticipated to return to its sustainable long-term trend in 2024/2025, bolstered by investments in oil-related infrastructure, the energy sector, transportation, and a recovery in the manufacturing and construction sectors. In addition, potentially more robust external demand for Uganda's exports and supportive government expenditure are expected to elevate economic growth above the 7% in the medium to long term. Nevertheless, economic growth remains highly uncertain, with the balance of risks leaning towards the downside. The potential downside risks include protracted weak global growth and lower commodity prices, constraining Uganda's export earnings and widening the current account deficit. Secondly, a resurgence of the supply chain distortions due to geopolitical tensions and fragmentation. Thirdly, a potentially lower external concessional financing, which could restrict government expenditure. Fourthly, higher public debt burden could weaken the local currency, limit government's borrowing capacity, and slow foreign investor inflows. Fifthly, a combination of a moderate private sector credit growth, rising domestic interest rates, fiscal consolidation, and the shilling depreciation could weigh down growth. And finally, higher frequency and intensity of climate shocks, including droughts and floods, may undermine agricultural activity and worsen food insecurity. On the upside, the slowdown in global economic growth in the near term may be less severe than anticipated, and a faster regional trade integration could bolster potential growth in the medium term. Also, domestic economic growth could surpass expectations, aided by supportive government expenditure and private sector investments in the extractive industry. Heeding caution, mainly because of the elevated uncertainty in the global financial markets amidst slowed global growth, coupled with the dominant impact of the vagaries of weather on agricultural production, the MPC views the downside risks dominating economic outlook. The dominance of the downside risks to economic outlook, coupled with the growth remaining below its long-run average, poses challenges to the sustainable restoration of price stability, without urgent measures to boost productivity and enhance the economy's supply side. Therefore, it is imperative to consolidate the gains made by tight monetary policy, helped by fiscal consolidation, in restraining the recent inflationary pressures while undertaking commensurate interventions to upscale the production and the productivity of the economy. In other words, the fight against inflation can sustainably be won in the long run by boosting the economy's supply side to meet the growing needs of a dynamic economy that is undergoing structural transformation. This will require boosting economic production and productivity to foster sustainable macroeconomic stability for economic growth and development. After careful deliberation, the MPC recognized that significant risks persist in the economy and that the current monetary policy stance remains appropriate to consolidate the gains made and restore price stability while supporting economic growth. As a result, the MPC has decided to maintain the CBR at 10%. The CBR's operational bands will remain at plus and minus 2 percentage points, while the margin on the CBR for the rediscount and the bank rate will be maintained at 3 and 4 percentage points respectively. Consequently, the rediscounts and the bank rates will remain at 13% and 14% respectively. Also to note is that despite the recent challenges experienced in the United States and European banking sectors, the domestic financial system remains resilient and on track to meet the revised regulatory requirements, including those related to higher minimum paid-up capital. The future adjustments to the monetary policy stance will be contingent upon new information regarding inflation and growth. That marks the end of the reading of the monetary policy statement for the month of June 2023. Thank you for your kind attention.